Hello, everybody, and welcome to another episode of Capital Ideas, where we celebrate the ideas that enrich our lives and the capital markets that help make it all happen. I'm Nick Morgan. I'm the co-founder of ICAN, the Investor Choice Advocates Network, and the co-host of this podcast, Capital Ideas.
And I'm Dara Albright, and I am the co-host of Capital Ideas and proud board member of ICAN. And today we have with us Woodie Neiss, who I'm so excited. Woody's an old friend. He is known as one of the fathers of the whole crowdfunding movement. And he is the co-founder, Woody, of Crowdfund Capital Advisors.
Correct.
And he's working on a lot of great projects in the space. Glad to have you on. And let's get started. You were really involved in this industry from the beginning. As I say, one of the fathers of the crowdfunding movement, or grandfathers, if you will, if you want to go that far. But really from early.
Gray hairs there.
Right. And I thought that, maybe you could start by talking a little bit about the progress you've seen with respect to equities crowdfunding from the beginning until now, what you're seeing.
So we built a database that collects information on all the companies that are raising money through Regulation Crowdfunding, and it went live on May 16, 2016. We collect 125 data points on all these issuers that looks at every single offering that they do. So if they do follow-on rounds, we capture all that. We capture all their revenues for each round. We capture their revenues in annual reports. We capture the valuations. We capture everything that we can capture. And with that data, we do a lot of analysis and reporting that's even used by the Securities and Exchange Commission. And so when the industry got started, if you just look at the data itself, it was a very slow adoption. It was just, a few $1 million each month. Now we're at the point where in October, this past October, which was the 10th best month for investment crowdfunding, it was about $52.4 million of committed capital. So we have just moved tremendously upwards. It's about $2.1 billion that have been funded. There's been about 6,600 plus issuers that have come into the space and run about 7,600 offerings. So I would say that the model's working, the adoption's there. We need to get more media coverage of what's happening. But we're in this period where there's been a dynamic shift in the type of companies that are coming online. When the industry got started, it was a lot of, what you think it would be, these startups that are pre-revenue, the riskiest type of companies. But, the SEC put that change in 2021 that lifted the cap from 1 million to 5 million. And all of a sudden, the profile of the companies coming in changed dramatically. Now we've got 65% of the companies that are post-revenue and greater than 3 years old. So, it's been a fundamental shift. These companies are raising a lot more money. I think in October last month, it was $715,000 was the average raise. So when you compare that to the companies that first launched and were raising about 150,000, and that gradually went up to 250, we're seeing this upward momentum taking place. And I think, it just speaks volumes in so many different directions, from, just the type of issuers that are coming in, and it's for Main Street type businesses, it's for startups, it's for women and minorities, but it's also now for these more established issuers that need up to $5 million. And, I think, what you're working on, Nick, is really important too, because I think we need to take the promise and what has worked and go back to Washington and be like, listen, we've had very little fraud. There's been one instance where SEC enforcement, and I'm sure there's others that they could do for noncompliance with annual reporting and all that. But, that's not where you find fraud per se. The one instance of fraud was captured because we've got this disclosure regime in place, which doesn't exist in the private capital markets, which for the first time is published into Edgar, so we can actually hold people accountable. I think that's the reason why the SEC needs to look at this. Congress needs to look at this, look at the 430,000 jobs that have been supported by this, and say, let's move the cap from 5 million now up to 20 million. So I'll stop right there before I rattle on even more.
Here. I am in complete agreement on raising the cap. And in fact, that was good. I was actually going to say, do you think that we should raise the cap? But I agree. And what would that amount be? 20 million seems like the right amount to me, because you're still far below the Reg A plus, but that seems to be, the right amount. And you think about Intel went public, they raised $8 million on its IPO. So,
Okay.
look at that. It's almost in that range. But I was curious. I was reading a lot about what you were up to, and I saw that you were doing some interesting work with AI. And I was wondering how you are incorporating AI into the crowdfunding space, and how AI is being used to maybe even facilitate the growth of equities crowdfunding.
So I see the two challenges in terms of equity crowdfunding. One is media awareness and exposure. For the life of me, I just do not understand why your major news networks, your CNBCs, your Bloombergs are not covering this industry with the zeal that it should be. I mean, you've got all these entrepreneurs that are doing amazing things, creating innovation all around the country. I mean, 1,200 cities have had successful offerings now. I think that's a story. The fact that you've got, like I said, 40% of these offerings, women and minorities, that's a story. I just don't understand why the media attention's not there, but I know the media attention will be there when some of these retail investors that put, $5,000 or $10,000 into one of these startups back in 2016 or 2017 have an exit and it turns into 500,000 or $1 million. I think that sensation, because we know media is driven by sensation, is what's going to drive more attention to what's happening in the industry, which is what we need as an industry. The second part that's missing in the industry is the fact that we don't have institutional capital that's here. Now, if you look at what happened with the peer-to-peer lending space, that marketplace really took off as soon as institutional capital realized, okay, they've come up with ways in which they can look at these, the loans, and they can, price these loans appropriately for the risk. Now we've got metrics that we can apply to what's happening in investment crowdfunding, and we can use those metrics to actually help us guide investment decisions. And so my thought process was, if institutional capital is another missing link, if we can create a pathway for institutional capital to get into the marketplace, because they can't do diligence on thousands of these small issuers, they don't have the bandwidth to do it. And it takes a little bit of time, but you can also learn from what's happening with these companies that are raising money online. But if we can create this sort of algorithm using machine learning that can look at all the companies that have raised money through equity crowdfunding, then look at signals from ones that have failed to ones that have succeeded. And then now we look at the subset of ones that have succeeded, and we look at those that have gone for follow-on rounds of financing and look at their revenue changes, their expense changes, their earnings changes. We look at their valuation changes, okay? So we look at signals from their follow-on rounds, and then we look at what happens in their annual reports, and we track that. So we looked at all that information, and then on top of that, we also added in, is the company in business, out of business? Or we have no idea what happened to them. Then we looked at, has the company gone on for a round of financing outside of equity crowdfunding? So has a venture capital invested in them, or have they, there's been a couple scenarios where we've had a couple IPOs now. So we track all that within our algorithm, and we built this algorithm that looks at all that and looks at the signals of those companies that have done the progress, done the annual reporting, had the follow-on rounds of financing through VCs, tracked the valuations with them, or done the exits through an IPO. And it took us about 18 months to build this algorithm that looks for those predictive signals in those companies that have been the graduates. Then we retrain it over and over again with the current data set. We pull out companies in there, we retrain it again, and then you start taking the new companies and you bringing them in, and you see, do the new companies coming in have any similar signals or patterns to the companies that have gone on? And it's really just math. You're building this algorithm that's looking for the numbers that match up to what other companies that have gone on to do great things have the criteria. So we built that algorithm, and then about last summer, we started testing it where we would get the predictive model on a weekly basis that says these companies are ones that you should look at. And look at means that you need to now do what an algorithm cannot do, which is an algorithm's great at quantitative research. I mean, AI allows you to analyze, machine, big language, models and all that stuff, but it still doesn't replace what a human can do in terms of, okay, does this entrepreneur have experience building a business before? Have they done it in a similar industry? Have they been funded by VCs before? How much money, have they raised in that exercise? Have they had an exit? Those are the type of things that you sort of want to start asking. Then you want to look at the total addressable market. You want to, figure out things about the company, like what's the exit? Who's going to buy this company? And so in our investment committee, and there's 7 of us on that, and we have to have unanimous consent. So it's not an easy threshold to get through. We look at what the algorithm says. We look at the investor sentiment into it, because that's a key driver from the algorithm. Like, how many people are getting behind this deal? What's the average check size that they're writing? Because the bigger the check size means that somebody knows something that we don't know, that they're willing to risk more capital and write bigger checks. So that type of stuff makes us think we really should be honing in on the team and what they're doing in the market and who's going to buy them. And then we make an investment decision. Usually we have questions, by the way, and the questions are pretty much standard, which is your financials were from 2022. We're now almost done with 2023. Can you tell us how you performed for the last couple quarters in relation to your prior financials, so we can compare those to see if they're on track? Can you tell us about any issues or challenges that you've had that have come up since you did your last round of financing? You'd be surprised at how open people are, particularly when we say, we're with D3 VC, a venture fund that's interested in investing in your company, how quickly they do respond to us. But then we make an investment decision and we invest in those companies. And the goal of D3 VC now is, it's a $5 million starter fund. We are, going with a plan of investing $25,000 into 200 companies. So it's a diversified play. And there's been a lot of research that's been done by MIT, by Harvard, people much smarter than me, because I don't have a PhD. I just like to talk a lot. And so what that research has done or proven is the more investments that VCs have made over time, the better the returns. So VC funds that focus on just a few companies and hope for one outlier, their returns are not always so great. The ones that focus on more companies tend to have higher yields over time. So we're just applying that research that these PhDs have done, along with our PhDs that have built this algorithm, and said we want to invest in 200 companies with the goal of having like 10 to 20 or 30 outliers in that. And you can look through the data, because we can backtest everything, because we have the data, to see examples of where we probably would have made an investment and what it would be today. And Boxable is a perfect example of that. They started their online journey at $42 million. They were building these casitas, it's prefab type of housing type of stuff. But, here in Colorado, where I am, in the mountains, they need low-income housing. So you could see how this pertains to areas in the mountains where they need to build lots of these prefab type of communities for people that work on the ski resorts and all that. So they started with that $42 million valuation. They've now graduated through Reg A offerings. Their latest valuation is a $3.3 billion valuation. They have not gone public yet. Okay, so if our fund had spotlighted them, if the algorithm had picked up on the traction, and they've had a lot of traction from an investor sentiment point of view early on, and we put $25,000 into that offering, it would be worth $2 million today. And they, like I said, they haven't even had an exit. So if the algorithm can show that what we're doing works, and we then start showing these, mark to paper, because, it's still 7 to 10 years to have exits. But we can also build a case for what's happening, because that's what VCs do anyway. We can then go to our institutional capital friends and say, listen, you guys have hundreds of millions of dollars, but you don't have the bandwidth to do this. Our fund one was our tester fund, but what if we had $100 million? Think about how many companies we could put that into. We don't have to write $25,000 checks anymore. We could write $100,000 checks, but it would allow us to get into a lot of these really exciting, promising companies at their earliest stages of, valuation and get the upside of that, because that's where most of the wealth generation is made.
Incredible. I love the data-driven approach, Woody. That's and you've obviously done a lot of work, not just collecting the data, but analyzing it too. So I think that's in answer to your question, why aren't people paying more attention? I think you've just answered part of it. Like publicizing what you're doing is I think going to help all of us. You mentioned the Reg CF cap and possibly seeing to get that raised. And that brings up one of the issues we talk a lot about at ICAN, which is regulatory impediments to growing the industry. What are some of the regulatory impediments that you see that affect either investors or issuers or platforms in the crowdfunding space?
I mean, I hear a lot of complaints. Issuers don't like to deal with the CPA review. They don't like to deal with the costs associated with doing that. I'll be honest, I want it. I want that CPA review. I don't care if it costs you money to raise money. That's the whole point. You are raising potentially millions of dollars from investors. They need to know that some third party, other than, you putting your financials together, has verified that you actually have a structure and you're following a procedure for recording how checks are received, how money is, spent, and all that stuff. I like it. I understand those are things that people just don't know how to do also. And I understand that that is a hurdle in itself, but there's so many players in this space now. I don't know, Dara, if you remember when the industry got started, we had that event in Washington, D.C. to highlight the different people that would play different roles in this space. So when I hear people complaining, like, I don't know how to do it, I was like, it's as easy as a Google search. What do you need help with? And, there's, who does that, a crowdfunding review, you can find these service providers out there. From a platform perspective, I think there's still things that need to be ironed out. Like there's risks that they put on a platform that they haven't like FINRA hasn't held platforms necessarily totally accountable for material misstatements by issuers, but they could. And I don't think that's right. Like, if they do come down with an enforcement action against one of these platforms, I'm going to be the first to say, well, you actually don't give them the ability as a funding portal to actually do vetting. Like, because that means they're ranking them, they're approving them, they're putting them ahead of another offering out there. So unless you're going to change the regs, you can't do the enforcement action. But that leaves this gray area. And if there's one thing we all know is markets don't operate well when there's gray. So people need certainty. So I think we need to address the gray areas for the platforms that are out there as well. I think for the investors, accredited investors can do so much. And I think that's great. They can write these big checks. And we've got these workarounds going on now where, let's do a parallel offering. So we've got, a Reg CF and a Reg D, and then, we'll put all the accredited investors. I mean, do we really need to? Because it's just an added layer of bureaucracy. It's an added layer of cost. You can try and stop it, but if there are you can try and stop it, but if there's current regulatory structures that allow you to do what you want to do, people will do it. So, and I'll be the first to say, I was never a complainer with how regulation crowdfunding kicked off. When we went to DC, we had an 8-point framework. We turned that into a bill. That then went to the floor as, a bill in the House. When it got over the Senate, I don't know if anybody knows this, but there were 3 competing bills. And there were 2 Democrats and 1 Republican behind those bills, and they weren't talking to each other. So Jason, Zach, and I had to sit down with the 3 bills and be like, well, if they're not going to talk to each other, we actually have to merge the 3 of those together. And we went back to all 3 of them with the common sense compromise and said, it's not what everybody wants, but it is a compromise that gets us to, the starting line. And that was the final, bill that went through Congress that the president signed. And my point when I heard so many people complaining, it's not flexible. It doesn't allow this. I'm like, we have a starting point. Okay. This industry is taken off. It's proven itself, I think, phenomenally. The fact that we've got all these entrepreneurs around the country doing this in over 600 industries. Okay. When this got started, I was like, okay, I can see like Main Street type of businesses that are cash flowing, doing debt offerings. I can see a lot of these software companies out of Silicon Valley that aren't going to get VC funding because they're not ready yet, trying their hands at this. I didn't realize there'd be 197 biotech offerings. We're putting a report together on the whole biotech sector in crowdfunding. I mean, that's crazy to me. Like, I never would have envisioned that when we were in Washington. But to know that it doesn't matter what industry you're in. If you've got a great idea, you got a great team, and you clearly have done something before, you got a community that will fund you. People are coming in. We don't have to say, try it anymore. The reality is it's there. More and more people will be using it by default. So, the good, the bad, the ugly, I don't care. We're there. We're moving forward. It's only going to get better.
I love the outlook. That's fantastic. Hey, thanks so much for joining us on Capital Ideas, Woody. I really appreciate you coming on. And for the rest of you, please look for more information about ICAN at icanlaw.org. Thank you, Woody. Thank you, Dara. And we'll see you on the next Capital Ideas.